And welcome to the Real Investment Show. Of course, it is Thursday, and that means that Michael Lebowitz joining us this morning. And the topic of the day is, of course, inflation, because inflation is really the concern that drives a few things here. First of all, inflation is important for the average American because obviously higher rates of inflation, they kind of crimps your lifestyle a bit here, right? Your dollars that you earn simply don't go as far as they should because you're paying higher prices for things that you live on every day. Now, unfortunately, we don't count some of those things that you pay for every day in the inflation calculation. We try to strip those things out like food and gas, basic living essentials. And so we don't calculate those. Then there's some other things that I shouldn't say the Bureau of Labor Statistics tries to account for and tries to make an accounting of relative to how it impacts the economy as a whole. Things like rent and homeowners' prices. Now, we need a quick trip in history here just to get, to kind of lay a baseline of how we got here before we start talking about what here is. Previous to about 1998, inflation was calculated on a fairly reliable basis and a logical one. There was a basket of goods, and each year that same basket of goods was repriced, and the difference between the prices in the baskets of goods from one year to the next was inflation. And so it was fairly reliable. Think about it this way. You go down to the store, you buy a dozen eggs today, and the next year you go buy a dozen eggs on the same day. You compare the prices. That's your inflation, right? So fairly logical approach. Well, in 1996, 97, 98, and if you remember, there was a very brief moment that we didn't have a budget deficit. And that brief moment was when Bill Clinton raided Social Security, took $2 trillion out of Social Security, put it into the general budget, and replaced the Social Security money with IOUs. And that very briefly created a budget surplus. Now, here's the problem with that is that it didn't last long because we didn't change any of our spending behaviors, and we quickly went back into a deficit. But in order to suppress, because now we have these IOUs now sitting in Social Security, we needed to change the calculation of inflation to suppress the amount of payments that go out every year for Social Security. Those are called the COLA adjustments, cost of living adjustments for Social Security. So the Clinton administration brought in the Boston Commission. The Boston Commission said, oh, yeah, we can make some changes here. And we changed things from like home prices to homeowners equivalent rent. And we adjusted for things called hedonics, saying, well, if you bought a computer in 1990 versus a computer today, computers today are a lot more powerful and they cost less, so that's deflation. So, we did all these jiggerings to CPI to suppress the rate of inflation growth. And this is why we haven't had inflation in 20 years, right? It's been very low rate, despite the fact that the average homeowner is struggling to make ends meet, because food costs are going up and everything else. Now, long story short, to get us to, that's as we say in Texas, that's how we go the long way around the barn to get to the door. Michael Lebowitz did a very interesting deep dive into one of the major components of the CPI calculation. Mike, what did you find out?
30% of CPI is broken down into what they call shelter. Shelter is broken down into two categories: owner's equivalent rent, which we call OER, and then just rent. And what's important to understand with shelter, the whole 30%, is that the Fed wants to capture rent. That's what they view as consumption. Right or wrong, it doesn't matter. That's what they do. And that goes back decades. So they try to capture rent, and they capture it in two ways. One is what they call owner's equivalent rent, and that is essentially looking at housing values via survey and trying to assess what the rent would be. That's 23%. The other 7% is more straightforward. It's just asking people that are renting what they're renting it for. Here's the problem. And first of all, let me just back up one step. you're probably asking yourself, well, what about housing? House prices are going through the moon. Shouldn't that be part of inflation? And the Fed's response would be that that's a financial asset, that doesn't count. Even though most of us live in the houses that we pay a mortgage on, and that's probably our biggest dollar outflow every month, that doesn't count.
Well, now,
right?
now, just to back up to what I was saying a little while earlier, prior to 1998, when we changed the inflation calculation, home prices were the measure for inflation, and we actually did use those. And again, this adjustment from the Boston Commission was well, we need to change this to homeowners equivalent rent because we can now manipulate how we calculate that number.
Right, and what they would say is not manipulate, but stabilize it.
Exactly.
What they don't want prices going up and down. What they're trying to do is capture longer term trends. Right,
Sure.
right or wrong, that's how they do it.
Sounds great.
So, right, it's also worth, Lance. It's also worth. The Fed uses PCE. That's the Fed's preferred inflation, personal consumption expenditures. They certainly look at CPI, and it's very important to them, but PCE is the one they kind of rest their laurels on. PCE doesn't include shelter at all.
Right.
So, they look at things without food, gas, shelter.
The things you pay for.
What else do we spend money on?
Exactly.
Next thing you know, they're going to take out beer and football. Then what do we got? We got nothing.
You got nothing. What you have is deflation at that point.
So we go back to CPI and say, okay, they're looking at rent, and rent prices should follow mortgage prices. If someone asked me what I could rent my house for, I'd pull out a spreadsheet. I'd say, okay, here's my mortgage payment. Here's my kind of monthly upkeep. Here are my taxes, miscellaneous fees related to my house. And I'd say, okay, that's $500. I need to clear $500 so that I'm making money or at least breaking even on my house. And that would be what I would call my imputed rent.
Sure.
That's the rent that, at a minimum, I would charge. Then you kind of have supply and demand of the market. But if you can't get me $500 for my house on a monthly basis, there's no reason for me to rent it. And that's a broad statement, and I get it. And a lot of people rent houses for very different reasons, but that's the methodology. So when you go in and you look at both OER and rent in the BLS data, there is zero correlation between OER, which is the 23%, and house prices. But again, they're not using house prices. But there's a very high correlation between house prices and mortgage payments. So if you just do some calculations on what's the national average house price, and you calculate a mortgage payment, that should give you a very good indicator of what rent should be for the entire housing population. Right? There is also zero correlation. Now, here's the more disturbing part. Remember I said rents were 7%. That's where they just go ask people, what are you paying in rent? There's zero correlation between that, and Zillow puts out a rent index. It's a combination of rents that are actually charged and an estimate. They call it Zestimate. Just like they do on their house prices, they do it for rents. I'm not saying Zillow's perfect and they do everything right, but again, there's almost no correlation. Statistically, there's zero correlation. It's insignificant, meaning that Zillow's estimate of rent prices has the two figures have nothing to do with each other. It'd be like if Lance was asking me every day what to wear, and I would tell him based on the weather up here in Maryland versus Texas. There's no correlation between what he should wear and what my weather is. And unfortunately, when you go through, there's no way to predict CPI because there's no correlation between 30% of CPI and what's going on in the real world and reality.
Yeah, and let's step back to Zillow for a second, because this is something that has always been kind of an interesting situation. Is, look, I can understand back in the 80s and the 90s, the Bureau of Labor Statistics had to do surveys by phone, right? They call people up. They said, "Hey, Mike, what do you pay for rent? What do you pay for eggs? Whatever it is." It was done by a phone survey. Today, is a vastly different story. Zillow has data. The reason they come up with their Zestimate for Zillow on home prices as well as rent is they have a massive amount of data in their system of homes that are in their system, what they're renting for, what they're selling for. So that data is available. Employment. We have Paychecks, we have ADP, we have all these other companies out there that do payroll. They have actual payroll data, yet the BLS is doing phone surveys on the first Tuesday of every month going, "Hey Mike, you working?" When do government agencies move into the 21st century, or more importantly, do they not even want to, because the real data is vastly different than what their surveys are putting out.
Lance, they have their own tax data.
Right.
They have their payroll taxes. They have real estate taxes. They have their own data they could at least begin the process with. Right. But it's almost as if they're wed to their old ways, and they like, for whatever reason, a way that they can manipulate results to get stability, which is what they want. They don't want CPI going up and down, and I get that. They want to show the trend versus the month-to-month gyrations, but it's becoming a little bit ridiculous.
Right, and look, honestly, this really comes down to Social Security, which is a $170 trillion unfunded liability. And this year, they're already going to have a 6% increase in COLA adjustments because of inflation. And we just got the Social Security trustees report out last week. I've got a report coming up on this. The trustees situation is deteriorating rapidly for SSI, showing it's going to, Social Security recipients are looking at basically benefit cuts by 2034. So, they've got problems, and they certainly don't need payments going up, because that would accelerate the process of bankruptcy for Social Security. Be right back after the break. We'll talk about exactly what this inflation number should be, what it is, and what this means for inflation and the Fed's taper. Don't go away. And welcome back to the show this morning. Michael Lebowitz joining me. We're talking a little bit about inflation, and this important kind of part of it is that, one of the big battles for individuals for years. This has been going on for years. In fact, we were writing articles about this back, and right after the turn of the century, as Fed speakers were making comments and saying things like, well, inflation remains low. And there was a comment made previously said, let them eat iPads, right? Because iPad prices were going up, and we don't calculate those things and side of inflation. We use this thing called a hedonic adjustment to suppress prices of technology in particular. Even though the prices are going up, we say they're not, because you're getting more for your money in terms of they're more powerful. So we make this deflationary adjustment to suppress the impact of higher prices. And this is an important point, because we've got a Federal Reserve now that is doing $120 billion a month in quantitative easing. Their driver is primarily focuses on two things. One is the employment situation. So are we or are we not at full employment? Well, right now, as of the last employment report, we're at 5.2% unemployment. Now, that means that what that means is essentially is that 94.8% of the entire labor force that is available for work has a job. Now, I think pretty much in most every environment, you would consider a 94.8 percentile success rate of anything to be pretty darn near perfect. I mean, that's pretty high. I mean, if you're going to, there's always people in a workforce that are never going to work for one reason or the other. They just don't want to work, whatever it is. They're not going to work. But 94.8%, you gotta suggest that and that's one. And by the way, historically speaking, 95% has always been equated to full employment. Just by the way, the other thing is inflation. And of course, the Fed's been talking about for a while that we need to be above 2% inflation, and 2% is the target rate of inflation. We need to be there, et cetera, so forth and so on. Got it. Problem is the calculation of CPI, and that's what we're talking about this morning, because if you take a look around, the average person is going, hey, I got inflation like crazy. My house is going up, my rent's going up, my food's going up, my gas is going up. What do you mean there's no inflation? And this is that angst that we get from people, right? because their lives are being very much impacted by higher costs. Tuition, insurance, healthcare, all these things are going up in price, yet the inflation measure says there is no inflation. And of course, this is what got Mike prompted to dig into the homeowner's equivalent rent, because we're looking at home prices as a function of incomes is at the highest level ever on record right now.
Right.
So how can there not be, higher prices? And again, this is what you discovered, Mike, looking in and looking into the numbers. There's no correlation between what the Fed says is rent inflation versus what's really going on in rent.
Right. And look, to be honest, there is higher inflation, right? CPI and PC are both running at 10+ year highs. But I think if you ask anyone how much have things gone up in price, the things they consume most, they would give you a number a lot more than 5%.
Right.
I mean, just poke around. It's not hard to easily get to 5%. But I think here's why this is so important today. If we would have had this discussion in June, when's the Fed going to taper, or in May? We both would have said, look, inflation is running hot, but it's transitory. Things like gasoline and used cars and rental car prices, all those things, as the economy adjusts and normalizes, will stop rising in price, and they'll actually start falling. They'll actually provide a little bit of deflationary pressure to the broader inflation indices. And we both would have said that employment is what we need to be looking out for. Since over the last 3 months, employment, the number of jobs has risen by, guesstimating here, but about 800,000 jobs a week, which gets you to say gets you to about 2.5 million jobs over the last 3 months, approximately. We are well on our way to full employment if we're not there already, like Lance just said. Complicating that is the fact that we just learned yesterday there's almost 11 million job openings, but there's only 8 million technically unemployed people, meaning that there's a job for everyone, and they're still looking for 3 million people to fill other jobs.
Right.
There's a lot of flaws in that data, but if you go back and look at where we were before the pandemic, it was at a very similar ratio.
Right.
So maybe we're not at full employment, but there's enough jobs out there that if people want jobs, they can get jobs. So to me, if I was on the Fed, I'd say we have fulfilled our mission. We have brought employment down to approximately where it was. I know the unemployment rate is whatever it is, 5.2% today, and it was, a point and a half lower. I get it. But if you really look through the data, we are there, and it's nothing we can do anymore. People just have to take jobs. And maybe that will change once this unemployment benefits end, which it ended last week. And, we'll see that in a couple months, whether that is truly have an effect. So now we fulfilled our employment mission. We have more than fulfilled our inflation mission. This is where I would be very scared if I was the Fed. What if we got inflation wrong? What if it's not transitory? What if transitory is 2 years? Right, we're hearing these chip shortages could last well into 2023. That tells me that new car prices are going to stay elevated, meaning there aren't going to be a lot of used cars available on the market. They could stay up. There's a lot of other things that are applying upward pressure because these shortages are not going away nearly as quick as anyone thought they were.
Right.
And then you got the big elephant in the room. 30% of CPI is based on essentially indirectly house prices and rent, both of which are going up 15, 20% a year. So even if CPI captures some of that, captures a third of it, you have a big increase coming to CPI, even if used car prices start. Right? Used cars, I think, are 3%. Gasoline is 5%, 6%. You're talking about 30%, right? It's a third of the CPI index could potentially jump in price. Now, again, there's no correlation. A third of the index could drop like a rock.
Exactly.
Right? We're literally flipping coins, throwing darts at a dartboard.
But
that's the problem.
Yeah.
And that's where I think the market is going to start getting very uneasy. I think they're starting to see what we're seeing, and you're starting to see a little more volatility creep in. And it feels like the market is starting to question the Fed. Are they
Yeah, and I think that's the real question here. You've got $120 billion a month. And again, as we started out the show talking about, is that, the entire thesis for most investors right now is no longer about fundamentals at all. It's not about, hey, I'm buying this company that trades at a discount to fair value. We're buying stocks that are trading at multiples of fair value. And
Right.
the justification for doing that is oh, well, the Fed's got my back. It's $120 billion a month in QE. And I think this is where the Fed's getting into a real trap for themselves, because they've got to be looking at the economic data slowing down. They've got to be looking at record valuations. In fact, we've heard more and more Fed speakers now mentioning excessive valuations in the markets. And they realize that if they start to taper their balance sheet, they're going to have a market correction, which is going to impact confidence. And at the same time, you've got this inflationary pressure and employment problem. So what do you do?
But I also think that you have a potential confidence problem if they keep the pedal to the metal, because the market's going to start saying, okay, I get it. Liquidity is good for us, but what are you doing? Inflation is starting to get really hot, and inflation is not good for stock prices, for stock valuations. So that's why this is a trap. They're kind of getting cornered in. And because they left the situation for so long, they should have been doing tapering 6 months ago, 9 months ago even.
Yep.
And they didn't. And now the economy is slowing quickly, right? It's not just us saying this. Goldman, Morgan Stanley, even the Fed is telling you that growth is going to be somewhat normal for the third quarter at 3. They're all kind of in a 3% range.
Right.
A little high compared to normal, but much more normal than what we've seen for the last 4 or 5 quarters.
Right.
And they're gonna take their foot off the pedal at that point. And I think they're all, I think the Fed's all in agreement. It's just a question of whether they announce it yesterday or whether they announce it in November.
Right.
Right. That's the big debate that's going on at the Fed. And I think there's a lot of Fed members that are increasingly worried about inflation.
Yeah. Well, so the Fed meeting is week after next for September? Because you got one in September, then one in November. So, I mean, theoretically, we could see a announcement on some, really kind of that first setup for taper come as early as the end of this month. And it'll be interesting to see how the market responds to that. Technically and historically, what happens is when the Fed has announced taper, the markets tend to kind of slough that off. They go, yeah, okay, they're going to start tapering, and that's going to happen in 3 months or 6 months or whatever they think the number is. And they're going to go from 120 billion a month to 110 billion a month. No big deal. Markets kind of hang in there, and that's kind of what I would expect to happen here. But again, given the fact the markets had such a large run, is so deviated from long-term means, and have such low volatility now. You've got internal deterioration going on. There may be a bigger response to this than we might expect. In fact, more and more of the kind of the major investment houses are starting to talk about a correction between 10 to 20% coming sooner rather than later. We'll talk about that with Michael Lebowitz when we come back from the break. Don't go away. All right, getting ready to wrap things up. What does all this mean, right, for markets and the Fed? And, of course, as I said, more and more of the major institutions are starting to come out now and warn of a 10 to 20% correction in the markets. Does that mean tomorrow? Does that mean go sell everything today? No, that's not what that means. But as we have talked about here for a while, this very low volatility environment that we've been in over the last really 6, 7, 8 months, really since last November, has really exceeded durations that normally in markets you have a correction of 5 to 10% with some regularity. 20% corrections in any given year are not outside the realm of possibility. And the last time that we had a year where we went 12 months of ultra low volatility was in 2017. And then in 2018, you had 3 near 20% corrections. So, it's this idea that low volatility breeds high volatility, and what stipulates that change is a change in the underlying narrative. And of course, that underlying narrative remains the Fed and taper. And so there's some things that are going on. I mean, look, you've got a valuation deviation right now. Valuations are extremely high levels, and we keep ratcheting up numbers. I just wrote an article on Tuesday talking about S&P 5,000. Analysts are now rushing to push prices higher, and not because they can value that. It's simply playing catch up with stocks. The return this year has exceeded a lot of their price targets, so now they just ratchet up to the next highest level. It says, okay, that's their next target. Doesn't matter that they're going to be right or wrong. It's just they have to put a target out there. So that's their target, 5,000 now. It's a nice big round number. But the problem is that if you do get that, even though you're getting growth in earnings, which, by the way, the earnings expectations, as we stated would happen, have already started to get ratcheted down here going into 2022. So all of a sudden, these very high levels of expectations starting to come down because of weaker economic growth, but yet price targets are going up. So that means valuations remain elevated. We're at the second highest level valuations on record, and in some measures, we're at the highest level of valuations on record ever in history. So, what you're paying for investments is certainly something worth paying attention to. But again, a lot of these major banks starting to come to this realization, hey, the economy's slowing down, earnings are going to come down. And that is really what you have to start watching for when you have an overpriced, overextended markets. That's what tends to lead to corrections. Now, what you need for that is some type of catalyst, some type of statement, some type of action, some type of issue that spooks the markets, changes psychology from bullish to bearish, and that creates that kind of first initial wave of selling. And that's going to be the first thing we kind of set up for. So I'm going to throw this back to Mike. So, Mike, with this kind of premise, and now that more and more, one thing is that with more and more banks coming online to say there might be a correction, maybe there won't be a correction, because generally by the time the institutions are telling you something, it's, doesn't ever turn out to be that case, right? But, kind of what are some ideas here? Where should investors be looking to maybe put some money if they are worried about a correction? What should they be thinking about doing?
So I think we've seen the market doing a little bit of this already, right? If you look at what has performed really well in the last couple months, it's utilities, which tend to be more fairly valued. I'm not saying they're cheap, but they're more fairly valued. Mm-hmm. The real estate REIT sector. And then you have kind of technology and communications, which are that primarily means Google, Facebook, Amazon, and Microsoft, right? That's what we mean by technology and communications these days. And it's thought that those companies have very stable earnings, that when we go into a recession, Microsoft's earnings don't flip around too much. People aren't going to use Google less, et cetera, Facebook, same with Apple. So the market has been gravitating towards those sectors. We've also seen bond yields drop. Bonds are traditionally a safe place to invest when the stock market turns down because money flows into it. And look, I get it. You're not getting paid in yield, right? You're not going to make a whole lot of money in the coupon payment every 6 months, but you potentially can make a lot of money in the price change. And at this point, when you're looking at bonds, you have to think about what's the potential price change. And that may sound strange, but that's what investors are doing in stocks. Right? Anyone buying most stocks these days are not looking at what it's worth, because what it's worth is down. It's below where it's at today. What they're looking at is where can I get the next sucker to buy it at? And that's at a higher price. And bonds are a similar game, right? It's really about price. We used to buy a bond for yield. Hey, I get 5% a year. That's great. I'm happy with that. And the price will fluctuate, and I'll deal with those fluctuations. Now it's all about the price, not the yield or coupon. So I think first and foremost, just look at your portfolio, and if you're not comfortable, shift to more conservative, what we call lower beta, meaning that they react less to the market. Think about which sectors are more fairly valued. And, just in general, look at your exposure. If you have too many stocks and you don't sleep well, or if you look at, the market's down, S&P's down about 15 points, 20 points this morning, if that makes you anxious, you probably have a little too much stock. So just sell some. Bring that number down so that if the stock market does drop a few percent, or if it somehow drops more than a few percent, which I think is illegal now, Lance, you don't take as big losses. You can buy options. There's a number of ways to protect yourself, but I think first and foremost, pay attention, because the environment of the last year is not the environment we're in anymore. The Fed is changing. The Fed will be doing something. Now, whether that's in September or November or December, we don't know. And where we're at now is a point where stocks are valued so much more above what they're worth. So you can think of the price of a stock and you can go through its earnings, you can go through what its future products are, where it's going to find growth, where it may not find growth, and you can say, okay, I would pay 10 times what I think their earnings will be in 10 years. That to me is value, right? Mm-hmm. And we come up with a price of $100. Well, that stock price may be 150, and that extra 50 is the Fed. It's the liquidity. It's this feeling that the Fed is invincible and that the Fed can support prices just by keeping markets very liquid. And you have to ask yourself, is that 50 points just as valid as it was 4 months ago? And that's what the market's doing now. It's questioning that liquidity premium. Now, I can't tell you what that liquidity premium is worth, but I know it's worth a lot more than 5 or 10%. We can look at valuations. Mm-hmm. And like Lance said, just about every single one of them is in record territory. Even Cape, which we thought the 1990 high of, I think it was 44, was invincible territory. We're at 39 or 40 right now, right? If you go back to 29, it was in the low mid-30s. 1929, it was in the low mid-30s. Mm-hmm. And the historical average is closer to like 17 or 16. So you can easily make a case that we are 2 times overvalued, right? Doesn't mean the market's going to crash. Right? We've been very overvalued for a long time. And the Fed's very sensitive to the markets. The Feds will react at some point. They're not going to react if the market falls 1%, but will they react at 5%, 10%, 20%? They always seem to react. Mm-hmm. So follow what's going on. Look at, pay closer attention to the sector rotations. Right? We've had a lot of days where what we'll say is the generals are doing well, but the troops are falling behind. So the FANG stocks, Facebook, Apple, Netflix, Google, etc., Tesla, are all having good days, and the market may be up 5 or 10 points, but then you look at your portfolio and 3/4 of it is red. Mm-hmm. And look at the market, 3/4 of it is red, and that's what's been going on. So the generals are giving the appearance that the market is strong and doing well, but we have to look at all these underlying signs, look at valuations, look at what's going on in bonds, look at what's going on with cash levels and try to foresee what's going to happen. And again, if you're anxious and you can't sleep, you own too many stocks.
Right. And I think that's really kind of the key point here is that, if you look at, how you're allocated, a lot of people have gotten over allocated to technology because that's been one of the areas that's been doing well. So, but it's not just in, good, reliable, strong, fundamentally strong technology stocks. There's a lot of companies that people are buying into that have no earnings growth. They have no revenue growth. They're very speculative areas. So it's important to make sure and look at what you own and really understand why you own it. And if you can't, it really comes down to the 2 things. One is if you don't know what the company does, you probably shouldn't own it, right? And if you only own it, and if your whole thesis is, well, it's been going up a lot, maybe that's a good time. And again, this is, the question we always get is like, should I sell it? And no, you don't have to sell the whole thing. You can sell some of it, take some of your profits off the table and hold the rest of it still going up, manage the position and have a trailing stop on it. Pick a point somewhere in space that says, if the stock retraces back to this point, I'm not going to lose any more of my gains. At least have some measure out there to reduce the risk of giving up all of your money. And, I can't tell you how many times people go, well, I don't want to sell it because I don't want to pay taxes on it. Well, the easiest way not to pay taxes on a stock is to turn it back into a loser and then sell it, because then you don't have any gains. So, manage the portfolio. The whole goal is to make money here, and to make money with the least amount of risk possible. And if you can do that, you'll kind of win the long-term game. Whether or not we get a 10 or 20% correction this year, nobody knows. But there's certainly the risk building that we will, simply from a function of time and duration and extension. the kind of the laws of physics apply to markets just like anything else. So pay attention to your money, of course. Always get by our website, realinvestmentadvice.com. Michael Leibowwitz's latest article is out on this inflation number, all the charts and data to back it up, as well as our recent article on S&P 5000. It's all on the website now, realinvestmentadvice.com. Sign up for our daily market commentary. That'll be coming out here in just a few minutes for you. So if you subscribe now at the website, realinvestmentadvice.com, you'll come to your email inbox. And, of course, our newsletter will be out this weekend. Stay tuned for the next show tomorrow, realinvestmentadvice.com. See you then.
It's a rich man's world.